Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media like we normally do. I'm going to interject my financial opinions like I normally do. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in, take a look, see what's going on. If you want to follow me, it's @_finance. And if you want to join our community, finding-value.com, I dive into all this stuff, share potential investment opportunities with everyone in the community. I share my opinions freely on individual stocks, companies. I can't give advice, but I do share what I'm doing. And you guys can follow the companies I'm buying. I share all of my purchases, the time, the time or date, and the price that I purchased it at, and I share that on the website so you can see it. I also do midweek updates showing you the patterns and the setups so you can also learn how to do it yourself if you'd like. Special is the coupon code that we've got going on. It is a good deal, 50% off the first month, but the first month only. And it's a larger discount on the yearly membership if anyone wants to not mess around with monthly payments or anything like that. You can just do it in one big shot and get savings doing it. All right, so HFI research. I sincerely hope no one is taking the EIA STEO seriously. The STEO is so bad that it can't get backward-looking data correctly. Please do not use it for forward-looking forecasts. And that's what I've noticed. I've noticed that the data from the Energy Information Agency is jacked. It's totally jacked. They're always underestimating demand and overestimating supply uh, all the time, and they can't even update historical information correctly. It's all jacked up. HFI research, I'm not sure what data he uses, but he says our crude estimate for this week, the EIA oil storage report, he's looking for a draw of 2.8 million barrels over this past week. So we're still getting, well, we should be getting some draws here in oil over time. Who can be a successful investor? Let's go through this together and see if this is an actual uh, if I believe what they're telling you is actually good information or good lessons. So, anyone willing to put in hard work and who can follow simple rules, trade in the direction of the overall trend, buy low, sell high, cut your losses short, let your winners run. Investing in stocks takes the same kind of preparation and training as for any successful endeavor. The market has trained professionals that are experienced in taking your money. Would you rent a set of clubs, hit a few, and then play against Tiger Woods for money? To be successful, you must learn the business of investing and have a plan. The smarter you are, the longer it takes. Yeah, I don't know if that is right. That whole set of rules. Um, in my opinion, I would do different rules. I don't think this is a good uh, cheat sheet, in my opinion. So, who can be a successful investor? Most people can be successful investors. The way that I would approach the markets, this is what I would say: buy undervaluation. Undervaluation is defined by a price that the market is selling a stock at versus the value of the business that is behind the stock. So buy undervaluation. It's not buying low and selling high. It's buying undervaluation and potentially not selling until it becomes vastly overvalued, or depending on the market or the business that it is, you may never sell the business if it's a good enough business. You want to buy a business that is so great and so powerful that you never have to sell. So you don't have to cut your losses short. I don't think that's a good strategy either. Well, some people will say, well, what if you're down 40 or 50%? That's pretty average on a new investment, if you're just entering a stock and you could be buying this at a very opportune time, and some news comes up and you're down 20-30% in the stock, that's par for the course, guys. That's par for the course. But if you're buying under valuation, you let it run. And then when that company comes back into cycle, you may be up many, many, many hundreds of percent. So another rule that you need is asymmetry. You want to buy something that's very cheap that has a very good growth potential. So asymmetry, buying undervaluation are much, much more valuable than this garbage list that they have listed here. It says investing in stocks takes the same kind of preparation and training as for any successful endeavor. The market has trained professionals that are experienced in taking your money. Guys, I will say this: trained professionals, some of them, are not that good. People who do these financial advisors, are they trained professionals? Kind of, yeah. Are they good at timing market or do anything? No. Do they buy undervaluation? No. They'll just say go buy an S&P 500, do some allocation to XYZ, and that's it. You'll just get the market return. No one can beat it. That's what they'll say. I think the market can be absolutely smoked, but you have to buy undervaluation. You have to. Here's another, I think, important thing if you want to be a successful investor. This is some of the most important things that people. This is going to be the hardest thing to get right. You must buy undervaluation, and you must buy when people are fearful, because the best undervaluation, or the greatest mismatch between fair value and completely out of price, we'll say large undervaluation, is when people are scared. And the way to make money is you have to go against the grain. And that is absolutely everything that you have to do is against the entire world. Everyone feels comfortable if someone has a similar opinion to them. So when you buy this undervaluation, there could be fear in the market. The news is telling you that the rig counts are dropping, that oil is going to go to $40 a barrel, and maybe we're at 50 something or $60 a barrel. You have to buy when everyone's telling you it's bad. You have to, if you can cut the emotions out, you just laugh at everything. And if you can somehow, with time, have a mentor that tells you what you need to focus on, and you step back and you look at it, you can actually look at this whole mess of a game. I was going to say of the world, but there's a big mess in the world too. But you can kind of like separate yourself from the herd, look back at the herd, and say, oh, that's how you play the game. You just have all these people running around chasing price performance. They're chasing price performance in this: buy low, sell high. Well, what's the value? Value's your protection. I mean, this is like saying, oh, it's easy to play football, run fast. Yeah, stop running when juke them if they're running left, you run right. It's like, well, no, duh. It's like that's easy, but you need to practice, cutting and turning and doing certain things, and knowing where their defense may be, so you can run where they're not. That's kind of what we're doing with investing. We're running where everyone else is not. They're running out of the building. We're running into the building. Everybody's yelling fire. We're running into this fire, buying the fire sale that's out there because everyone is scared. And once you figure this out, once you just see it, and I don't know how to let other people see it, you just look back and you say, God, this is ridiculous. It is so dumb. This game is not that hard once you can kind of figure it out. Now, that doesn't mean that every single investment that you enter will be successful in the beginning. It may take time. You might be down 20, 30, 40%, and you might be damn good at entry points. Part of the game. You won't be right on everything. Technical analysis isn't 100%. That's what you need to know. You need to know where your boundaries are at when you invest. Your boundaries of, I can get so far with this. If I buy on 60+% pullbacks. Maybe it's 61.8. It's a Fibonacci retracement level where aggressive stocks generally pull back to. If you're always looking at a general area, you limit your downside by knowing how much these stocks generally pull back. Now, if you're in some high risk company that doesn't make any money, it may not follow some of those rules. You might pull back all the way and even go below where it pulled back. There's no bottom on something that's going to dilute you to death. And that's understanding risk. It's understanding the companies that you're entering. It's understanding the market conditions, money flowing into the sector and out of the sector. All of those things added up will make you a successful investor. The more you stack on, the better you become. What do I mean by more stacking on? The more you know about the company, the more you know about the sector, the more you know about break-even costs and cost curves and where they're located, the more conviction you can get using all of this information. The ratios. Is this expensive to gold? Is it cheap? If it's cheap, you're underneath the cost curve. You're in a company that is not a ton of debt, has some debt maybe, and you're buying it at an area where it technically looks pretty good. Well, that seems like good. You're doing all the work that you can potentially do to buy something. That is what makes someone successful. You don't just buy crap because a chart tells you to. Your success will be equivalent to understanding as much as you can of whatever thing you're trying to understand. The less you know about it, the more you can get smoked. And that's where your losses here. Cut your losses short. That's generally, and this is my opinion, that's generally good for people who don't know what the hell they're buying. If you're buying something incredibly cheap, like let's say you're buying a house in 2009, 10, and 11, which is the bottom of the market. Let's say you're an expert in the real estate cycle. So your cycle, you know that we went into an oversupply phase in 2005, 6, 7, 8. You know that there was going to be a pullback coming. We get the pullback and we get a recession. The recession bottoms out in 09, 10, and 11, and you're buying in 09 and 10. That doesn't mean that you grab the absolute bottom of it. You might still have gotten $20,000 less than what you paid for on a house, or maybe $50,000. But you're buying in the general location of where you should. You're getting the good deal. You're getting the best house for the money that you're paying for it. Getting the absolute bottom, it's tricky. And I don't know if anyone can reliably and consistently buy absolute bottoms within pennies or 50 cents or whatever, or a dollar, depending on how much the stock is worth, of that bottom. But you can, I mean, that's the limits of the game that you need to learn. How close can you get? What does good look like? What does bad look like? What is a good entry? How can you flub an entry? That's what you need to learn to be a successful investor, in my opinion. Jesse Livermore, and I like reading these things because I've got my own opinions now of what it takes to be good. So the one sure way to succeed in the market. Oh, it's a one sure way. Tell your readers that there's no magic about success in the stock market. That the only way I know for anyone to succeed in his investments is for him to investigate before he invests, to look before he leaps, to stick to the fundamentals and disregard everything else. No man can succeed in the market unless he acquires a fundamental knowledge of economics and thoroughly familiarizes himself with conditions of every sort. The financial position of a company, its past history, production, as well as the state of the industry in which it is engaged, and the general economic situation. I don't think Jesse Livermore said this. Livermore was a trader. This sounds like someone else. That does not sound like Jesse Livermore. And I think some of this, if you can combine technicals and fundamentals and cycles, that's all you can do. That's basically everything that somebody can do. So you understand a little bit of the shorter term cycles, the longer term cycles, and then you understand valuation with the cycles and how money flows has an impact. These cycles have an impact on how money flows in the markets. Interest rates is a big driver of a lot of this, of cycles. Simple but to the point. So what this is called a normal distribution curve. That is what this is called. A normal distribution curve, you have 3 standard deviations where the majority of this curve is contained within 3 standard deviations. So 3 standard deviations plus or minus amongst the mean. The market spends most of the time here between the -2 and 2 standard deviations around this distribution, this normal distribution. This is called statistics. All right. To sum this up really quick, this is the entire strategy that I have, right? If you buy valuation, if this here is a function of valuation, right? It's not price. Use it as valuation. I can buy a 2 standard deviation or below valuation all day, right? So I create a portfolio when the price moves to this crash area. Now, people aren't going to come out and be like, oh, it's crashed. It's crashed. It's just totally crashed out. Though that's an opinion. The reason I set up ratios is I can tell you with certainty when this occurs over here. Then I also can tell you with certainty when this occurs in the bubble. If you're always buying under valuation, what happens? You're always buying over here. If I'm always buying over here, I just have to wait because the market spends most of the time in the middle as it goes from here to here and back. The majority of the time it spends is in the middle because no matter what it does, it has to transfer and go through the average and mean area every single time when you go from crash to bubble, bubble to crash. And it usually goes slow between that. So what I do, and what everyone needs to do, is the fear and the sentiment is the worst in crashes. I can assimilate an entire portfolio of sectors that are over here. And then I just wait. Everyone wants to get rich quick. But what if, I mean, I do too, don't get me wrong. I'd love to get rich quick, but what if I'm a realist? What if I say, it's really hard to get rich quick and you have to take on copious amounts of risk to do it? What I've done is I say, okay, I'm going to, buy stuff that's cheap and then sit and wait. And then when it goes over here, I will have many, many millions, maybe even billions of dollars by the time I pass away, right? And that's not necessarily the goal, but that's how you make your money. You buy undervaluation, you wait for it to get more overvalued, and that's it. And if you can constrain yourself to always buying undervaluation, what does it do? It always keeps you on the left-hand side of this curve. It always keeps you on the cheap end over the undervaluation of this curve. And that's really the only thing that can protect you against anything in the market. That's the only thing. It's valuation. Valuation and time combined. Everything else, we can't tell you when something's going to go up. I can't tell you when it's going to go back down. No one knows that. No one. And yeah, there are people probably in the market trying to manipulate interest rates and hold things up and hold things down. There is a mess of that too with the Federal Reserve and all that. This is an important chart. You need to learn it. And it doesn't, you don't need to learn it you don't need to dive all the way in. You just need to know that it exists. You need to know that a lot of the time you avoid bubbles, you avoid crashes, or you run to crashes. And that emotionally, you need to know that it's hard to perform these actions. Nugget says NCP continues to make mega bank on U.S. oilfield services ads. Thanks to everybody who listened to the self-identified experts about avoiding the space the last couple of months. Shout out to Sankey Research, a BOL lady at NCP this morning, and a lot of these experts are getting it wrong. You know what? So this chart here has no emotions, has no sentiment indicator. It's just value. Think of it as value. A lot of these companies are over here that he's describing here. And the sentiment pushed these all over here. We are literally we are over 3 standard deviations with the gold to oil price. Think about that for a second. That's called an opportunity. But everybody thinks, oh, it's going to go to 30, it's going to go to 40. Rubbish. Doesn't matter if it does or doesn't. If it does, buy more because it's going to come all the way back over here to a bubble, and the bubble is going to be way up there. We go to a 3 standard deviation bubble, that's $300, $400, $500 a barrel oil, maybe even more than that. If we go 3 standard deviation against gold, you're talking like $800 a barrel oil or something. 3 standard deviations, that's going to get you like a 1 to 5 ratio if you beat that. We're at 30, let's just call it 3,500 if that were to do it at a 1 to 5 ratio. That's $700 a barrel oil. I know this stuff. Most other people, they don't know. Oh, it could be $700 a barrel oil. Watch your dollar value. Silver showing some similarities to its move in 2020. If momentum continues, it could reach $45 in the coming weeks. Notice that he's focusing on just price. You know, here's my opinion, guys. And this is kind of zoomed in. This is just zoomed in, and yeah, we could get a breakout. Everybody gets all excited. Oh, it could go to $45. Big picture view. What's driving silver? What is driving human beings to buy silver? Answer that question. And tell me if whatever's driving the behavior behind humans to buy silver, tell me when that changes. Whatever conditions are driving the humans to buy it, whenever that changes is when I become bearish on silver. I think we're going to see a big bull market in silver. Interest rates are the driver. Brian Feroldi, it's true. It says the stock market will always attract people who are in a rush to build wealth, but build wealth for people who are not in a rush. And that's transferring money from the impatient to the patient. We are taking advantage of those that are impatient and fearful and emotional. And we are the person sitting in the hammock, just sitting there waiting for them to crap themselves. And we can steal shares in the market when everyone else is in a hurry to get rich. None of those people, very few people get rich very fast. There are some, and I'm sure there's a lot of envious people that want to get rich quick. Like maybe you ride the biggest bubble in history and you did it in a very short period of time. That's called luck. It's not called skill for a lot of those people. They can't replicate that success either. Nassim says, what matters in life isn't how frequently one is right about outcomes, but how much one makes when one is right. And that is 100% correct. That's called asymmetry. Asymmetry is something that everyone should learn. What that means is that I can risk money, and maybe I go down 50 to 100% on some of it, but my upside is maybe tens of thousands of percents versus my 100% loss if you go to the extremes. So it's not about how many on a percent basis outcome that you get right. The name of the game is if you do win, you want to win at 100 to 1 ratio or 300 to 1 ratio, where every dollar returns 300 in return. There's other things that I think people mess up on. For instance, people will say, I'll take on a whole bunch of risk to get a return. What you want to do is you want to find something where you create that gigantic asymmetry. So, for instance, I would rather avoid a company that doesn't make money and run into a company that makes money, but they'll say, well, it doesn't go up as much. We'll figure out products that can get you leverage then. Maybe it is, and I'm not suggesting by any means this, but I'll just give you an example. I would rather go into a company that has good leverage, good cash flow, maybe there's some other things that they've got, and put a product on it, a vehicle that has even more leverage. I would rather do that than increase my risk to infinity and think that I could beat it while taking on copious amounts of risk. So I'd rather borrow money, so to speak, and buy a solid bet in a great market condition in a lower risk company than peg the risk meter all the way to max in a company that has a low probability of success. So I would rather have a high probability of success with less risk and then add risk through other means to add leverage to the play if I were to do something. OPEC Plus says missing their quota increased guidance was a major contributor in sending oil prices from 40 in November of 2020 to 130 in June of 2022. If there are more OPEC Plus quota increase misses, we could see a similar move higher, bullish oil. And here's another thing. A lot of people try to convert everything into narratives. People want to read things and then they feel good. They're like, oh, yeah, yeah, yeah. I hate to say it, but some things are not figured out. I'm not saying this particular quote here. I'm just saying in general. So the ratios or the valuations cuts through all the BS. You don't need narratives. You don't need news. You don't need any of that garbage because it keeps you on the right side of the cycle. You just need to know kind of roughly where you're at. Like how cheap are we? How expensive are we? And how, to what extent are we cheap or expensive? Warren Buffett says, I think people's investment would be more intelligent if stocks were quoted about once a year. The stock market is there to serve you, not to instruct you. What does that mean? This is what he's saying. People focus on price movements and then develop a narrative based off the price movement. So price drives narrative. The stock market isn't there to instruct you. It's not there to guide your path. It's not there to say if the stock goes down that the stock is bad. It's there to serve you. So when you look at it, if you can cut through the price and not use price as an indicator, you look at the valuation and maybe the patterns, then the market starts to serve you. It's not instructing you to do anything. So when the market moves fast to the downside, that's a price move that doesn't do anything to the value of the business. That's why you shouldn't sell just because it moves up or down, or buy. You shouldn't buy or sell based off price movements. What is technical analysis ultimately? It's ultimately a price measuring stick, and it is instructing you to buy or sell based off of price action in relationship to patterns. So that's where the disconnect between technical analysis occurs and fundamental analysis. But what if you can marry the two together and become a hybrid? What if you only took good chart patterns that also have incredibly good fundamentals? Well, now you're describing the way that I invest in my approach. This is such nonsense. Where is the oil? Not in the US, not in Europe, not in Canada. Why are we backwardated? Why is gas oil screaming? Yes, China has higher year over year stocks, but those numbers thrown around are total BS. So some people are questioning the validity of the data that people are sharing. It says, how rare is it for silver to be traded above $36 an ounce? Extremely rare. It has only traded above this level for 7 months in 2011 and a few more weeks in 1980. This means that there are very few people who bought silver at these prices and are waiting to sell it. Those who did probably gave up and sold long ago. This is why I don't expect to see a lot of resistance between here and the historic high of $50 an ounce. If the price starts running, we could get there in a heartbeat. Correct. He's 100% correct. Christine says, Drill Baby Drill was always political gaslighting by DJT. It equals higher prices ahead. You can only game the economy for so long. The GOP is out of time. And now there's a lot of projections of crude output falling in shale oil in 2026, coming right up ahead of us in Q1. Here it is. It says the twilight of U.S. shale is here. U.S. projects crude output to fall in 2026, first drop since 2021. A couple of updates here. Dry bulk, Capesize down 1%, Panamax is up 3%, and tankers, VLCC down 1%, Suezmax is flat. The Headless Horseman says 10 bagger shot, don't trade the stock. Yep, that's what I talked about last time. So we're going to end it there. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials coupon code. We've got a question and answer session. That is coming up on Sunday at 5 p.m. Mountain Time. And we've got a Platinum Midweek update that's released. So go check it out. It's uploaded to the website. And that is where I share my opinions about individual companies. But that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.